Hello traders, how are you? This is Wanjiru Gishangi of Forex Exploits Online Academy. How have you been? Have you created time to watch my previous videos? I hope so. On this video, this is a video request from a 9 to 5 trader. A 9 to 5 trader is a trader who is already employed. They have a job, but they still want to take part in Forex trading. So this strategy will fit well or will work well for people who don't really have much time to do market analysis. Also, it's beginner friendly and it's the easiest and most stable strategy that has good returns. When you talk about stability, this is a strategy that you can actually see in the market without so much struggle, and you can get at least 3 to 5 trades a week. So if you can pick 3 that you feel have good range or have good movement or heavy market, then you're good to go. So this strategy is beginner friendly, can be used by struggling traders, and also the 9 to 5. Now, which is this strategy that I'm talking about? Is basically trading stop hands. Okay, stop hands or liquidity grab. Of course, I'll explain that as we move on for beginners. Now, each strategy is about rules. I keep saying Forex is about rules. If you know the rules of your strategies, then your game. And now for this strategy, of course, we start with the rules. Before we get to the rules, I've already said it's about trading stop hands. So we need to understand some items before we get to the strategy. So now I'm going to approach this from a beginner perspective, just in case you're a beginner or you're still learning. So we're going to start from scratch. Okay. So now let's say you're a beginner or you're still trying to learn or to understand what all this is about. So as a beginner, the first thing you do is, of course, to Google what Forex is about. That's the best step. Don't ask other traders first. Use Google. So Google what Forex is about. What is this thing that you call Forex market? Is it legit? Okay, is it a scam? What is it? After you're done, now Google about the people who provide the platforms. These are the brokers. Talk about them. Google about them. Check the different brokers that are in the market. Check their regulations. Once you're done, now get the platforms or Google about the platforms. Now, when talking about platforms, this is basically the MT4, MT5, and the C Trader. If you're a beginner, there's a video on my YouTube channel on how to get started. So you can just rush there and watch that video. Now let's go to things to note. Remember, the name of the strategy is trading stop hands, or basically the title of the video is how to trade the stop hands. Now the stop hands is the same as liquidity grab. Now, how do you want to trade it? Of course, you want to trade it like a pro. Okay, like someone who really knows what they're doing. So what are time frames? Time frames are basically the time that the candlestick take to form, clear, and give room to the next candlestick. So the time frames are this. Okay, this is what we call time frame if you're a beginner. These are minute, 5 minutes, 15 minutes, an hour a day. Again, on the video on how to get started, you can get more information on the time frame. The next thing is understanding market structure. What is market structure? This is how the market moves. If you're on a buying cycle or a selling cycle, there are ways or rules how the market should be moving or how to identify a cycle. It's through market structure. Again, there's a video on the YouTube channel on how to understand market structure. But if I may just touch on market structure, if you're on a buying cycle, you expect the market to be creating higher highs with impulsive move, then reactive moves to make a higher low, then a higher high with an impulsive move, reactive move down, again impulsive move to create a higher high, reactive move down, and so on. This is what we call the buying cycle. Now with the buying cycle, these lows don't break the previous low. So this low cannot go lower than this low cannot go through lower than this. Any time frame, okay, can be any time frame. Remember, the market is fractal, so whether it's 1 month or it's daily or it's weekly, it should be the same if you're on a buying cycle. Then at some point, At some point on that cycle, because the market doesn't move on a straight line or in one trend only, at some point the market will break that low with an impulsive move. We'll talk about what an impulsive move is. But when it breaks structure, now you know we are no longer buying. Now we are preparing to sell. So what do you expect? You expect a reactive move back to some point, then come lower, breaking that impulsive reactive move, impulsive move. And so this becomes a selling cycle, this becomes a buying cycle. And there are times when the market just decides to be sideways, what we call the ranging cycle. So now, if you're a beginner, there's that video on market structure that you can watch. Okay. Now, what next? We need to understand what stop hunts and liquidity grab is. Now, when we talk about stop hunts, let's get here. When you talk about stop hunt, now look at this high. We already say this is a higher high, higher high, higher high. Now, when a high is broken, but it's not actually broken by the body of a candlestick, it's just a wick, like a tail like this. Just some tails or the wicks of a candlestick. Oh, I'm not really. Okay. But just tails. This high was broken by wicks or tails. This is what we call the liquidity grab, or what we call stop hunt. Okay, so stop hunt or liquidity grab is when a high, or actually even a low. Okay, let's use this low. So if the market comes back here, but throws a tail, but the candlestick closes above here, but this is just a tail, then throws another one. Don't mind the color. Okay, these wicks breaking this low, this is what we call the stop hunt. Can be stop hunt, can also be liquidity grab. Why are we calling it stop hunt? Because if you're buying, remember you buy from the low. If you're buying from this market hoping that it will go upward, where did you place your stop loss? It will be here. So these tails are actually supposed to hit your stops. Now, if you're also a buying trader and you did a buy order, or a buy, is it a limit or buy stop? It will be activated when it will be hit, and then it will be activated. So the stop hunt is actually just hitting those stops. Could it be a stop order? Can it be a stop loss? Whatever it is, as long as it is hit. Now that process or that action of actually hitting those stops, whether for the buy or for the sell, that is what we call the stop hunt. You're going to understand it more on an actual chart. I'm just drawing this to show you, but I'll show you on an actual chart. Then we have identifying points of interest. Now, when we talk about points of interest, these are the trap zones or the liquidity zones. Now, liquidity zones or the trap zones, these are the swing highs. This can be the yesterday's high. Okay, can be yesterday's high, can be yesterday's low. Remember, yesterday meaning the previous day. If you're a beginner, yesterday, it's the previous day. Yeah? Yesterday's high, yesterday's low. There's last week low. There's last week high. There's also last month high, last month low. Can also be a swing high or swing low. Of course, I'm going to show you this on an actual chart. So don't worry. So those are what we call trap zones, or where there's a lot of liquidity. If you want to understand more about liquidity, I have the liquidity book, or I have a chapter that talks about liquidity in a simpler way, ebook 5. We'll talk about the ebooks later, but you can get ebook 5 just to understand how to identify the zones. Then we have the blocks. Now, blocks, this can be order blocks, can be the buying blocks, selling blocks, which are also demand and supply zones. Okay, they're all the same, and they're also pivots. So whichever name takes it home for you, but it's good to understand that there are different types of blocks. That is also explained on ebook 5. So a buying block or a selling block is not just a block. There are 3 types, I'd say 3 or 4 types of blocks. So you need to understand what types of block. But because we want to keep this strategy as easy as possible, now the types of blocks don't matter. We just mark it as a block, and that will be it. Then we have the imbalance, or what we call inefficiency or fair value gap. Now for that, when we're talking about inefficiency of fair value gap is there are times that you find only one participant in the market. You find one big selling candlestick, and then the next one is here. So all this part here where there was no buying, it was just a sell. Now this is what we call the void, or the fair value gap, or the imbalance, or the inefficiency, where only one participant is available in the market. Also, it can be also a buying candlestick, where just there's a huge candlestick. And when they are not huge, by the way, if you're a beginner, you're also going to get, they could be tiny, they're not so big, but they are one color, okay, one participant, many of them. This is also inefficiency, okay. So from inefficiency, you're going to see all that on a chart. Then the fifth thing that you need to understand is the entry and exit. Now with entry, there's something that we call optimal entry. There's also the 50% entry, and of course the stop loss and take profit. There are videos on the YouTube channel again on how to place a stop loss, on how to place a take profit. But now for this video, let's talk about the optimal entry and the 50%. For me, I always like the 50%, but let me show you. Let's say I have a block or a buying block. So I have this buying block, or this is the point where I want to get into the market. So this is a buying block. I expect the market, so the market has already pushed impulsively up. I want it to come back into the block so that I can get into a buy and move higher. Now at this point, I have two options. I can either, remember I had a block before this market came back, I can either take 50% and do the entry. So this is my 50. So I can either have my order at 50% of this block, or I can take the optimal. Okay, so I can take this entry. So when we talk about the 50%, is basically at the 50% of your buying block or selling block or point of interest. So 50, you just divide your block into half. You can have an order there or there. For me, I usually feel, or personally, I trade the 50% because I find that it's more rewarding. Though at times I miss a lot of trades if the market doesn't get to the 50%. Again, try these things out and work with what works best for you. So those are the things to note when you want to trade the stop hands, or when you want to trade what I'll be guiding you on this video. Next are the rules. Remember, you may know all these, but if you don't know the rules on how to trade the stop hands, then it won't really make any sense. So here we have the rules, or what will you be looking for? What will you be looking for when you want to trade the stop hands as a pro? As we prepare to do that, remember, you can find me on Facebook, on my Forex page with the name Forex Exploits Online Academy. That is on Facebook. This is where we talk about my books and everything about the market. Okay. If you're not on social media, if you're not on Facebook, you can find us on LinkedIn using the same name, and of course on YouTube. Be very kind to subscribe and also watch the other videos. Now, if you're a beginner, this is where you want to start. You want to start from how to get started on Forex trading. Once you're done, you need to understand the market structure. Before now, you can know how to place a trade, a stop loss, trail stopping, and take profit. Then from there, of course, you can watch the other videos at your own convenience. So let's go back to our rules. So now, how do you trade these stop hands? One, on a higher time frame, when we talk about higher time frame, it can be anything from 1 hour. Mine personally, or the one that I like most, is using the 1 hour. So on higher time frame, in this case, the 1 hour, you're going to look for a trap zone. A trap zone. Remember, I've already explained what a trap zone is. This is yesterday's high, yesterday's low, last week low, last week high, last month high, okay? So this is a previous high or a swing high or low. So on a higher time frame, you're going to look for a trap zone where a candlestick has closed either above or below the range. Okay, above will be for a buy. So if you're on a 1 hour, you want to look for a range whereby, let's say you're using 1 hour, so it will be a yesterday's low where a candlestick has actually closed above yesterday's low. I'll show that on a chart. If it's on yesterday's high or last week high, you want a candlestick to close below. That's why we're saying below for a sell. That is for the higher time frame. Now you've gotten a yesterday's high, a yesterday's low, a last week high, a last week low. You've gotten it, and then you've had a candlestick either closing above for a buy or below for a sell. Now you move to step 2. Be careful to note the timestamp. Okay, I'll show you the timestamp. Then you move to step number 2. On lower time frame, find the market structure and break. Market structure and break, BMS, or what people are currently calling change of character. Now this break of market structure must be from an impassive move. Do you remember what I said about impassive moves? These are the very violent or very heavy moves that move to create higher highs. And then we have the zigzags or the slow moves, what we call the reactive move. Then another huge move to the top, breaking this high, then another reactive move. So this kind of move that is violent and breaks the previous high, those are what we call impassive moves. If you're on a selling cycle, you're going to find you have a low, okay, then we have the reactive move, the slow move, then another violent move, okay, and another slow move. So these moves here, these are what we call the impassive moves. These are what we call the impassive moves. So this says the break of market structure must be from an impassive move. Meaning, if the break of market structure happens from a reactive move, rule number 2 has been violated. And if a rule is violated, then that trade is not valid. Unless you just want to lose money, that trade is not valid. At least be teachable. Okay? Be teachable, meaning keep the rules. Number 3, now you've had your break of market structure from an impassive move. Number 3, identify the source of that move. Which move? The impassive move. What did it do? The impassive move that broke the structure. You need to know where did it come from. Did it either come from a block or did it come from an imbalance? Okay, did it come from a block or did it come from an imbalance? You can watch the imbalance video. And also, I think there's a video on identification of blocks. If I don't have a video on identification of blocks, I have written a whole ebook 5 on the types of blocks, which blocks to work on, which blocks to ignore. So you can read that from ebook 5 because I also think it has imbalance there, though there is a video on imbalance. So you've done all that, then you have the final step, which is wait for retest. Remember, we always said don't join in the trade with the fast move. Wait for the risk-free move where you don't risk so much. Actually, with this strategy, you find trades that you can risk 2 pips. Two pips. When was the last time you took a trade with a stop loss of 2 pips? That's the awesome part of this strategy. So number 4, wait for retest of that source and enter the trade either at optimal entry or at 50%. So stop loss should be either above or below the source. Then the take profit is the previous day high or low, okay, TP1, or end of that day, that specific day that you're trading, end of that trading day, or which is the same as the high of the day or low of the day, or of course the high time frame swing. You may use this strategy to swing, so meaning you can hold your trade for a day or 2 or even a week. You can use the higher time frame swing, high or low. Let me give you a secret. If you find this trade at the extremes, hold it. I mean, swing it. I'm going to show you an example where the market has moved 1,000 pips this month, as I record. We're in March, last month, just a few days. I'll show you an example of using this strategy where a currency has moved more than 1,000 pips. So if you find this specific trade setup at the extremes, swing it. It doesn't matter if you're a swing trader or not, hold it as much as your confidence can allow. Now let's get to a chart. So we'll be reading the rules, coming back to the chart. So rule number one, on higher time frame, we're going to look for a trap zone. Remember, yesterday is low, yesterday is high. So we go to a higher time frame. My choice is the 1 hour chart. So I'm on 1 hour chart. I'm going to identify either a yesterday's low or a yesterday's high. Now, if you're using the template, if you're using a customized template, there's usually this blue tracer. If you're using a customized template, there's a blue tracer. This blue tracer shows you the previous day high and previous day low, or yesterday's high or yesterday's low. So it's going to be very easy for you. But if you're using a naked chart, it's still okay. All you have to do is draw. That's why I've drawn this line here. So if you're using a naked chart, just draw a trend line. You pick your trend line and just draw on that low. Okay, so I've drawn just in case anyone is not using a template or they're using their phones anyway. So you're going to pick a low, a previous day low or yesterday's low. In this case, this is a time stamp that is very important, especially if you're a beginner. It's important to check the date so that when you go to the lower time frame, you don't confuse yourself. So we have this 1 hour chart. We have a yesterday's low. We want the market to have a candlestick closing above. Now, let me make something clear. We buy from the low. We sell from the high. So if I'm looking for a buy, what will I be looking for on a higher time frame? I'll be looking for the market that has been to yesterday's low and actually has a candlestick that has closed above yesterday's low. I hope I'm clear. I'm looking for a buy trade. So on my 1 hour chart, I'll look for yesterday's low. And today, when I want to trade, I'll wait for the market to actually have a candlestick closing above yesterday's low. That is on higher time frame. So here I have yesterday's low and I have this candlestick. Can you see this candlestick here? It has closed above this black line, which is showing my yesterday's low. So it has closed above. And that is all that I need on step one. A candlestick closing above my range. That is rule number one, above for a buy. So my step number one has been met. So what do I do next? Now I want to go to a lower time frame and find the market structure and break or change of character. So I'm going to go to a lower time frame. My combination, if I'm doing 1 hour, then I'll be looking for trade setup on the 15-minute time frame or the 5-minute, whichever works for that day. But for me, 15 minutes is king. If I'm going to use 4 hour as the higher time frame, I'll be trading the 30-minute or the 15-minute. So work with what works best for you. In this case, I'll be using the 15. So I go to 15 minutes that same day. Can you check my time stamp? Same day, same time. So I have this line showing yesterday's low. Okay. Then that specific day, I want to have break of market structure. So we have this low. If you go to 5 minutes, you're going to find that there's some, what we call the candlestick showing the break of market structure. So I'm looking for an impassive move. Impassive move that breaks previous structure. Okay, see this move here, this whole huge candlestick. Then number three, I want to identify the source of that move. Can either be a block or imbalance. So let's go. Where is it coming from? It's coming from a block. What kind of block is this? This is a buying block or a buying order block. How do you tell it's a buying block? Because it has a red candlestick and a very huge candlestick to the top side, meaning it's buying. What type of block is this? You can call it a strong block. You can call it an engulfing block, whatever you want to call it, but it's a block. So now I have highlighted my block. So what do I do now? I wait. While I'm waiting, I can actually divide my block so that I can get the 50%. And how do you do that? If you double click on any of the edges, you're going to get this middle highlight on your block. Then you can take the straight line, then just draw it there, just on that middle highlight. And so you have the 50% entry. So you have, now you can set your limits. Okay, your buy limit and orders and everything. So you can have your limit on the 50%, and you can also have the optimal one. Now, what next? You place a stop loss. Where is your stop loss? It's at the bottom. Since we are buying, then your stop loss should be at the bottom side of your source. So you have your stop loss for the 50%. If you're like me, you take the 50%. So you have your stop loss. If you're the optimal kind, you can have your stop loss here. So let's work with the 50%. So if the entry is there, how much is your stop loss? You have a 2.8 or 2.9, 2.8 stop loss. Okay, you have a 2.8, meaning you're risking 2.8 pips. Where is your take profit? Remember, while you're doing all that, the market is still retracing, so maybe your trade has not been hit. So what is your first take profit? It should be the previous day high. Okay, so your first take profit or your partials should at least be the previous day high. So if you risk 2.7 from the 50%, your take profit should be 41 pips. So I've already given you here. So the risk, you're risking 2.8 pips. The reward, you're expecting TP1 to give you 41 pips. What is the risk reward ratio? If you divide 41 by 2.8, it's 1:14.6, which is good for a day, right? That is good for a day. So let's say you're a swing trader, or maybe you did not want to take this take profit. You can actually hold it. If you go to the higher time frame, you can go back to the higher time frame and actually hold it until this break of market structure. You hold it. You see from this point here, it's just moving up and up. So if you're on 1 hour time frame, you can just hold it until the day the market will actually break the structure to the opposite direction. And now on lower time frame, or you can just hold it for 2 days. So if you held it for 3 days to the high, risking the same 2.8 pips, the reward would have been 128 pips to this TP2, and the risk reward is 1:45, which is cool, right? It's awesome, right? Hopefully. So let's see another example. So this is a buy. Let's see if we can get, this is also a buy. Let's see for a sell. We're using the same rules. Now for a sell trade, you'll be looking for yesterday's high on the higher time frame. Remember, we're moving with the rules, okay? Rules. So for a sell, you're looking for the yesterday's high and a candlestick closing below that range, because you want to sell. So we have yesterday's high here. We have yesterday's high. Then we have candlesticks coming above yesterday's high. Then a candlestick actually closing below that high. Something else. Let me give you secret number 2 of this strategy. The candlesticks that are violating or doing the stop hunt from yesterday's high or the trap zone, if they are 2 or less, the better. Okay, if it's just 2 candlesticks or just 2 tails, the better. But if it's also other tails, it's okay. But at least let there be a candlestick that has actually closed below that range. So rule number 1, set. Rule number 2, we go to the lower time frame and look for break of market structure, then identify where it's coming from. So here we have our yesterday's high. We have the break of market structure. Now, when you're looking for break of market structure, let's look. We have a high, higher low, higher high, higher low, higher high, higher low, and then change. So this change of character, this change of is what we call the break of market structure. You understand more when you watch the break of market structure or market structure video. So here we have the break of market structure. Where did that break come from? It came from this double Marubozu. Can you see this candlestick, the 2-tailed candlestick, this tail and this tail? You can actually take that as a block. This is one type of a block, where you take the tail of the upper candlestick or the lower candlestick. The upper wick of the lower candlestick and the bottom wick of the upper candlestick, that becomes a block. Okay, we call it the double Mariposa or the tailed block. Now, if you're selling, you can refine it, okay, to make sure that you're not having unnecessary volume or unnecessary space. If you want to sell, concentrate on the top wick only. If you find it on the buy, concentrate on the bottom wick only. So we've refined it to the top tail. And again, now with the top tail refinement to the top tail, we can either do the 50% entry or the optimal. Remember, we're looking for sales. So you can have your sell order at the 15 minutes or at the optimal. Again, you see what did the market do? It came back. That did not hit our stop loss. Where is the stop loss? At the top side. So you have your stop loss there, your 50% entry, and your optimal entry. And there you push. Now, which is the first TP? Now, there are instances where the previous day low is within, within the range, and you don't want to be cut out. So what do? You can actually push that trade to the low of the day or high of the day. How will you do that? You can use catch up. You see the red line here is what we call catch up, or the 13 EMA. It's awesome when it comes to trade exit. Okay, so the reason I have this EMA here is just to tell you that you don't actually have to use the previous day if it's within the range is too short. Okay, for example, you'd have TP'd here. It's still enough money, but look at the space between this point and the catch up. So you can actually use catch up. You only get out if there is violation. Okay, you can learn that from the beginner guide. So there you have your TP1 from the low of that day. You can actually hold it to the end of the day. Okay, you can hold it from this point to the end of the day, whichever works for you. So if you got into this trade, you'd be risking from the 50%, you'd be risking 5 pips. So you have 5 pips stop loss. How do you calculate pips? You pick the crosshair, take it to the entry, drag the middle number, set a decimal point. So that is 4.9 pips, which is basically 5. So risk 5 pips. And what's the reward again? So from your point of entry to the TP, you have 127.1 pips. So you risk 5 for a reward of 127 pips. What's the reward risk ratio? Is 1:25. Pretty cool. Now, if you got this trade at the top, or if you got this trade at the first retracement on the higher time frame, you can also get what you call a 2x2 trade. What is a 2-2 trade? A 2-2 trade is a trade that will also give you another trade. So don't just be quick to get your TP and forget about it. No, come back the following day for an entry. How will you get the entry? The market will actually retrace to another block within the trade that you took. Within the trade that you took. Why will it be going back? Because there is market inefficiency. There was a lot of movement in just one direction. The market will come back. So what you do when you're doing this, you look for different types of blocks. Different types of blocks. It can either be inefficiency, it can also be the hidden block. Now, in this case, it went back to the hidden block. Now, what's a hidden block? This is a candlestick that will actually be submerged by the 2 candlesticks on either side. You find this candlestick here and this candlestick here. You actually see that this candlestick is like it's non-existing. That is what we call a hidden block. And it's important that you understand the different types of blocks. Now, with the second trade, the 50% will not actually really work with the second. Sometimes it works, but it's not very common. So with the second entry, you actually want to take the optimal. So have your second entry at the low if you're selling, or at the high if you're buying for the second trade. So here you'll be risking 16 pips. And for the second day, you're taking it your TP at the low of that day, and the reward is 118 pips, which is basically 1:7. Still okay. Any trade that gives you more than 1:4 or 1:2 or 1:3, it's okay. It's still very okay, as it's a good trade. Okay, so that is the second example. So let's look for the final example. So here we have our most common or my most favorite tradable item, which is EURUSD. Now on the 1 hour chart, we're looking for either a trap zone on the high or the low. So in this case, we have a yesterday's high, on the higher time frame. Check the timestamp. We have this. Can you see this top hand? We adjust the tails, but the candlestick closed below the range. Remember, rule number 1 is for a candlestick to actually close below the range. So it threw a wick above yesterday's high, then came back and actually closed below the range. So what do we do? Now we're done with rule number 1. We go to rule number 2. So we get to our 15 minutes since we are on 1 hour. Look for market structure, okay, where we're having the high. Then from the high, instead the market violates, okay, instead of giving us the higher highs here, you can also watch the reversal pattern, the institutional reversal pattern video on YouTube. It will show you why I marked these points as 1, 2, 3. Okay, that is a reversal pattern that you can watch from the reversal video. So now we have break of market structure where this low was broken. What type of block did it give us? It gave us again a double maruboso. You see this tail and this tail, so you can just pick both of them. But since we are selling, we said we only concentrate or refine that block to the higher wick only. Now, what will you be looking for? You'll be looking for this market to go back into that range. And if it does, you can take either the first entry on the 50%, sorry, or the entry on the optimal entry. Where is your stop loss? Your stop loss is actually at the top, okay, on that tail there on this week. That's where you place your stop loss. Where is your take profit? You can take it from yesterday's low, the previous day low. You get your first TP, or you can actually push it to the end of the day or the low of that day, and you're good to go. In this case here, you're risking 2.5 pips. Your reward is 53 pips, meaning your risk reward ratio is 1:21. That's why I'm saying this strategy is really awesome if you can follow the rules. Now, day 2. Remember, we said this strategy has an opportunity to give you a 2x2 trade. So day 2, what do? You wait for the market to come retrace. In this case, it retraced back to the same block that it had given you the first trade. So go back. For the second entry, we said the 50% will not work. So what will you do? You take the optimal entry. So get in here and then push it. Now, in this case, it moved. This was like a peak trade. Okay, if you look at the 1 hour chart, you can see it was a peak trade, right? It was at the top there. So you could have held it for even more 3 days. So Monday, Tuesday, Wednesday, and actually exit on Thursday. So this is a trade that you could have held for 4 days. So when you go to the lower time frame, you can hold it to the higher time frame TP. So you're risking the same 2.5. The match that has moved is 253 pips. So what's the risk reward? So 253 divided by 2.5 is 1:11. That is pretty cool. So that is how to use this strategy. Now, let's say you're using a naked chart. I know there are people who really don't get it. There are people who don't get it until they actually see you doing the markups. And that is what we're going to do together on this final example. Something else, note that this strategy works for all tradable items. It's not specific to currencies only. No, you can use it to trade on any tradable item as long as it's offered on the MT4 or MT5 or C-Trader. Basically, as long as it's offered on Forex market platform, then you can use it. So let's use an exotic. Is it anything? Let's use a different tradable item that is not a currency. So here we're going to use UK 100. So let's use something that is not. So we're going to go to indices. I know there are so many indices traders, so let's go to an indices. So if you're a beginner and you feel like, oh, indices have a lot of money, then now let's work with an indices. So we're going to choose UK 100. Remember, it's not special. You can trade anything. So here you have your naked chart. So when it's all this naked and it's all green, first, of course, we're going to change our colors. So do away with the grid. set it as none. Bar up means buying, we can leave it as lime or give it a green color of choice. Bar down means selling, change it to red. Bull candle, same color as bar up. Bear candle, same color as bar down. Click OK. And there we have an awesome chart. Then change, these are bar charts. So we are going to change our type of chart from up here. So we have bar chart, then we have candlestick chart, and there we have our candlestick. It's by default that the chart opens on 1 hour chart, which is the most favorite as far as this strategy is concerned. Next thing is at least now to have stamps so that we can see each day. So how do you divide to have the days showing on your screen? You just click on Control Y. Control Y, the letter Y. So when you click on Control Y, you get now the daily division, so a day at a time. This is if you're not using a template. This is how to use it on a naked chart, and also if you're using your phone. So here, of course, you can see the lows, the highs. So you can just draw. Let's use this high. So let me change the color. So we have this yesterday's high. I hope you can see it. And make sure that your trend line is perfect. We have this yesterday's high because it's a high for this day. Then we have the following day, drawing a wick above that high, then closing. The candlestick that threw the tail above here, it actually closed below the range. So that is step number 1, met. So you're going to do our timestamp so that we can actually see the date. Now, what do we do next? Now we go to the lower time frame. So we're going to click on the 15 minutes. Go to the same times. What are we looking for here? We're looking for break of market structure. So we have all these range, then manipulation to the top, accumulate, manipulate, distribute. So here we have accumulation to the top, creating higher highs. Then we have this manipulation, accumulate, manipulate. When manipulation is happening, then the market is about to distribute. It will break structure. It will break structure. So here we have the break of market structure. I'm actually doing it from scratch so that you know how to do it yourself. So here we have break of market structure, break market structure. So here we have break of market structure. Now after break of market structure, and remember the break of market structure must be impassive. Very huge candlesticks, very huge candlestick, a lot of volume. So we have break of market structure. What do you want next? You want to know where that break of market structure came from. Of course, it came from this candlestick. Remember, when you're marking, this market has not happened. So this is an imbalance. You see, this is a very huge candlestick. So you can mark it as a block. Okay. You can do the 50%. How do you do the 50%? You double click on the edges, then you have your straight line there. Okay. What else? Now you can move. That would be your entry. So you have the 50%, or you can decide to actually wait for the market and just get a sell from this side. Where is your stop loss in this case? You have your stop loss up here. Where is your take profit? You can either push it to the end of the day, okay, low to the end of the day, or you can go to the higher time frame. You can push it back to the 1 hour chart and push it to the lowest. So if you actually joined this trade here, you would have held it the whole from, actually, you would have held it for 2 days, which is some good money. Let's see how many pips that was. Sorry. Let's see how many pips from our entry. That is 506 pips. And how much were you risking? So you risk 24 pips. Remember, this is an indices. So you risk 24 pips for 508. Wow, that's cool, right? So those are the steps of trading these strategy. So be very, very keen. And remember what I said, it can give you a 2x2 trade, meaning the following day you come back, wait for it to hit the high, retesting a hidden or an imbalance or something, then get in and hold it to the end of the day. So 2 days of a trade. So guys, I hope you're excited to learn this. Okay. Now let me show you the example that I told you. that has moved more than 1,000 pips. Look at these guys. Now, this trade has moved more than 1,000 pips. So if you use this strategy and actually got into this trade and held it, you would have earned more than 1,000 pips. How? Look at this. This is our previous high. There are tails up there. Okay, broken. See how much that trade has moved and has not given you this trade all through. It was one of a kind. The strategy rules were met and those rules were not violated or done or repeated. Check that out. Ain't that amazing? That is 1,000+ pips. Meaning this is a strategy that you really need, okay, to understand or to learn. Guys, this is amazing, and I hope that it will change your trading, and I hope that it will actually be something that you'll be interested to learn. Again, be kind to subscribe on my YouTube channel, watch the other videos depending with your level of trading and what you're lacking. Don't forget to give us feedback. Don't forget to come back to our Forex page on Facebook, inbox your topics, ask for topics that you'd want me to talk about. Give us your feedback, give us your challenges. I'm really humbled to be part of your trading journey. Until the next video, I'm Wanjiru Gishangi. I wish you the very best. May you keep winning. May you keep growing, because Forex trading is a business like any other. Always approach it professionally. Never give up. It's indeed doable. Until next time, have a good one. Bye-bye.